Hello traders, this is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. In this video, I'll break down the outside bar model by Larry Williams. Going into a new trading day, traders are eager to make large amounts of profit. However, they do not have a plan and simply depend on lagging indicators. Larry Williams has presented traders a model in his book that I believe is beneficial to short-term traders and swing traders. Stay tuned. Leave the indicators alone. This will be a three-step process, starting with core curriculum, chart activity, and lesson plan. Let's jump right into core curriculum. In the book, Long-Term Secrets to Short-Term Trading, 2nd edition, by Larry Williams, we find in Chapter 7, Larry Williams provides price action patterns to profit. And I quote, "The next time you see an outside day with a close lower than the previous day, don't get scared. Get ready to buy." I quoted this off of page 128, and after reading it, I decided to investigate it for myself on present-day charts. In order to learn this model, you must define what an outside bar is. Larry Williams says that there are two candles that confuse retail traders. An outside bar is one of those candles. In this model, we're going to specifically looking for candles that break the previous daily high and previous daily low. More specifically, we're looking for the candles that close below the previous daily low or close above the previous daily high. On page 128 in the book, Larry Williams shows an example of an outside bar closing below the previous daily low. After that candle prints, we can see a reversal in the price action. Note that this example is on the daily time frame and not the lower time frame. According to Larry Williams, he said in the book that these candles only appear 7% of the time on the daily time frame. This is what an outside candle with a down close looks like. According to Larry Williams, this will be a buy setup in theory. Here we can see it looks bearish to the public eye because the close is below the low. This indeed can be a turning point. This is what an outside candle with an up close looks like. According to Larry Williams, this will be a sell setup in theory. Here we can see it looks bullish to the public eye because the close is above the high. This indeed can be a turning point. First, we will look at the daily time frame and see if a candle breaks a previous daily high and previous daily low. Next, we will determine if the candle close is above or below the previous daily high or previous daily low. Last, we will observe the price action after the outside candle forms. At gold in present time, and we're going to be looking for an outside day that either closes above the previous daily high or closes below the previous daily low. Larry Williams did say that this candle only shows itself at least 7% of the time, so they don't show as often on the daily time frame. So let's take a look. You can see here, I spot one right down there, so we'll use the replay function. We'll bring it back right here. This day here is November 8th, Monday 2022, so if you are looking at the chart, you can go back and see that example yourself as well. You can see the previous daily high is broken and the previous daily low. The candle as well closes below the previous daily low. So this, in theory, would be a buy alert by Larry Williams' model, right? This is an outside candle because it broke the previous daily high and the previous daily low, and the close is below the previous daily low, which would be a buy alert or buy signal. Larry Williams would suggest that buying is going to occur in the near future, so don't get afraid to buy. So let's see what happens after price presents this outside down close bar. And we can see the next day it opens, it does drop down, and then it gives a rally, bullish. Next day it drops down, rallies, bullish, and it rallies all the way up. Evidently, it also leads to where we are currently in price action. So you can see all the way through November, December, and even January, and going into February as well. You can see from that outside bar, that was where the moment in time had changed. This was the turning point here. So this was another opportunity to go long. Given that we are in an uptrend, you can see that the down close candles will present new opportunities to go long. But more specifically, if we're just looking at the model, we can see how this gave us an indication that tomorrow may have been a up day, or potentially in the next 2-3 days, a great buying opportunity would unfold. And here was a great example. Not too far, you see an example of an outside day bar with a down close right here. We can see the close is below the previous candle's low, and we did take out both sides of the market, so it's an outside range candle or outside bar candle. And this, by Larry Williams' theory, there should be a buy alert coming up. So when we play it forward, we can see how the next couple days there's bullish price action. Looking at pound yen, we can see that there is a large outside range candle with a down close right here. So we're bringing it back to here. Let's zoom in. And you can see that it takes out the previous daily high and the previous daily low. It closes below the candle's low. So Larry Williams would say tomorrow or potentially in the near future, there should be buying occurring. And what can we see occur? You can see the next day we don't get that initial buy, neither the following one until 3 days later. Then we start to see a run up and probably return back to break even or even slightly above profit. But moving forward with this example, we can see when we play it out, doesn't really give us any setup. It would have been a losing trade. So this one would have been ineffective. Here to the left, we can see there is a outside range bar here, a bullish example. So I'll bring it back there so we can check that out. You can see how the high is broken and the low is broken as well. So this would tell us don't be afraid to buy. Look for a buy setup according to Larry Williams, and we'll look to enter along the next daily open essentially, and we'll see what happens. And you can see immediately the next 2 days are bullish. So we can see that there is some type of dynamic movement when these outside range day occurs, especially if the candle itself is a small range candle. This is US dollar versus the Swiss franc, and we can see a bearish example or a sell example right here. So bring it back to here. This day is June 14th, Tuesday, 2022. And you can see how the candle takes out the previous daily low right there. And it also takes out the previous daily high. And the close is above the previous daily high. So in theory, by Larry Williams, this would be a sell alert. Don't be afraid to find a sell setup. And we'll see what happens the next day. We'll slow it down because I don't want to go in too fast. The next day, we do get the candle to open, does run up, and then drop lower. And then we get a large range candle after a small range cycle, down. So there is a method to the madness here that I see that Larry Williams is teaching traders from his book. And this also trends for a couple more days as well, which was a turning point eventually for U-Swissy. It's a little too slow. As you can see from there, I gave you that. A leg up, retracement into the range, another retracement outside of the range, external, and then one more time, sell stop sweep, and then it runs back, changing trend once more. Here in U-Swissy, we can also see an example of where Larry Williams would say this is a sell alert. You can see how price takes out the previous daily low and takes out the previous daily high, and then the candle closes above the previous daily high. So we'll check that out. So we can see here, September 13th, Tuesday, 2022, we get the previous daily high and low broken, and then the close is above the previous daily high. This would be a sell alert or sell model, and we'll see what happens the next day. So we can see that this model would have been a failed setup. I'm not going in thinking that every single setup that I see is going to be a winner, but it is a setup by theory. Concerned with the daily time frame according to his book. However, I said if price is fractal, then this would show on all time frames. Daily, weekly, monthly, yearly, 4 hour, 8 hour, 30 minute, 15, 5 minute, 3 minute, and even the 1 minute. So I decided to do some investigating on that as well. Within my Telegram channel discussion, I sent 2 screenshots of 2 setups that I saw on a lower time frame via the 5 minute using Larry Williams' model. You can see here, there's an outside candle here, and there's an outside candle here as well. So let's take a look at both examples. So starting with the first outside day candle, so we can see this candle is forming at 10 a.m., which is London close, to 12 p.m. So it's inside this time period. So I was just taking note of little things as I went along. You could see that it meets the requirements. It takes out the high and it takes out the low. The close is well below the previous candle's low. So in theory, by Larry Williams model, this should be an outside down close buy setup model. So what I thought to myself is, I'm just going to wait for the next candle to open, and whenever it opens, I'm just going to buy and have a stop loss below this candle's low here. So that was my thinking there. So you press play, and that was going to be my long position here, and my stop loss is going to be either here or below it. Then I was aiming for the actual high or some type of PD array or swing high above price. So then it was this swing high here that I was potentially looking for, or even this fair value gap for price to trade up into to take profits. So this is essentially what I was looking at. And as I played it out, it's on the 5 minutes, so I'll speed it up. Initially, I was able to see profit and see a turnaround. So this was a buy alert for me. And I was like, wow, that actually worked on the 5 minute time frame. That was amazing, you know? And I was like, this is short-term trading really quick. It took 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, basically an hour for this setup. And all I had to do was wait for the next daily candle to open. It's a daily. The next 5 minute candle to open and buy right there and hold to my terminus, which was either the fair value gap or the swing high that's above price here. Stop loss was below the actual wick or the low of this outside bar candle. So let's look at the second example. So if I just play this forward, because I know the second example is right around here. So there we go. So you can see price doesn't get to the final TP area for this setup, but of course you would want to scale out, you know, move your stop loss to either break even, or if you didn't move your stop loss, you didn't move your stop loss. You would have got stopped. But here you can see the same thing in theory is happening. Now this is outside of London close because this is 12 p.m. here outside of it. So this would be a later PM session setup. So you can see it reaches the requirements, it takes the high, it takes the low. Then I would be going long the next open of the next candle. So here, I would go long. My stop loss is going to be either at the actual outside bar candle's low or a little bit beneath it. Then I'm going to be aiming for some type of PD array or some type of swing high. We still have that swing high up here. We do have a more recent one here. So let's say real short term, we have one there. That's a swing high. But you want to be setting these trades up so that the risk to reward ratio is like worth your while. You don't want to get in and the risk to reward ratio is not worth your while. There are some setups that look good, but if you can't get in because the risk to reward ratio, isn't good, don't take this setup. So you can see these are potential areas that you can probably look to go long and aim for. And that's what I was speculating there in that screenshot. You even have a fair value gap here in between these candles there. If I could get it to draw there. If I pause it for a second. So here to here. You see how it hits that as well. And this is all on the 5 minute. Larry Williams in his book is only recommending the daily time frame. And gold ended up shooting really fast to the upside there. But that's what I was observing on the lower time frame. There are other examples that I put in my Telegram channel as well. I put the screenshots here as well so you guys can see it. First, we're only going to focus on the outside bar model. We're not going to add other models on top of it. I'm trying to keep it as simple as possible. I know that other models can possibly optimize it. However, we're just going to keep it as straightforward as Larry Williams said in the book, and we're only going to be focusing on the outside bar model. We're not going to be using any other logics or other patterns that we've seen. We're just using the outside bar model. After that, we're going to look at the technical analysis, meaning the price action, as in what day of the week is it? Are we in a premium? Are we in a discount? Is the actual outside bar candle itself a small candle or a large candle? Have we recently broke a swing high or a swing low? And what sessions are we trading in? Are we trading in New York, London, or Asian? After that, we could come down to a trade idea using proper risk management, TP, and stop loss. So with this last example, we'll tie all those things together. So let's say in theory, we have an outside bar with an up close, as we can see here. That's the high, that's the low, and it closes above that candle's high and it breaks both sides of the candle. We are also in the London session. This is 2 a.m. to 5 a.m. At this point, we're then going to set our parameters, our take profit and our stop loss. So we're going to be looking for a target. So most likely we're going to aim for a swing low because we know there's going to be sell side liquidity. So if we're getting into a sell side out, we don't want buy side liquidity being targeted. We want sell side liquidity targeted. After that, we're going to look for a reasonable stop loss, whether that is 5 pips above the actual high of the candle. So normally you come up 10 pips, which would be that. We would then get in short the next candle. So we're waiting for the next candle to open. So since this is the 5-minute time frame, we're waiting for the next 5-minute candle to open up. And that's when we will go short at its open. So that's where we would go short. Here, our stop loss would come up to 10 pips. And then we'll be aiming down for that swing low. You can even go onto the lower time frame, like the 3-minute time frame, scale down and look for a lower time frame exit. So like a fair value gap like this, right? Or even a bullish order block, something like that. Something for price to target back down to the discounted side of the market. You can also see, if we go to 2 a.m., this is 2 a.m.'s opening price, and you draw it out, we're in a premium. So for the session itself, we're above 2 a.m.'s opening price. So anything over here is going to be overbought. So high odds set up for a sell would occur. You have the Larry Williams outside model here on the 5-minute time frame here, and you'll place your risk, whether that is going to be 1%, 2%, 3%, whatever it is. You just can play around with the filters and the models. However, on the lower time frames, what I have figured out is that these outside bars show themselves much more frequent than on the higher time frames, like the daily, weekly, monthly, and the yearly. Like Larry Williams said in his book, on the daily, he had found statistically that it only appeared 7% of the time. So if you're a swing trader, you're going to be waiting for those exact moments. They don't happen as often. But if you're a short-term trader, if you scale down to the lower time frames and use those common codes, premium, meaning that it's overbought, or discount, meaning it's oversold, you can then find ways you can get into the market when you see a setup like this. And as you can see, you play it out. Price then on the 5-minute continues to trickle all the way down to the TP. So it took 5, 10, 15, 20, 25. It took 25 minutes for the trade. That's a very short-term trade. This brings me to the end of the video. I hope this video was valuable to you as a trader. If you enjoy this video, then I think you'll like these two as well. Please subscribe, like, or comment for more high-quality Forex videos. As always, safe trading, leave the indicators alone, and peace.